Hi there. Welcome back to yet another episode of E.M.I. That's Economy, Markets and Investments for you. This is the E.M.I. for the month of April. Let's jump right in. In this month's E.M.I., we look at US tariffs. And these are four key questions we are looking to address in this month's presentation. Why are emerging markets like India in the middle of a tariff war? What are the tariffs as of now? How does one quantify these risks? And what outcomes can India look out for? These are the four key questions. We start off with where India is and how we landed here. The chart on the right, before coming to India, the chart on the right talks about the trade surplus of all key countries with the United States. You can see India stands here. India has a trade surplus in and around roughly around $40 billion. Trade surplus would mean that India exports more to the US than it imports from the US. The chart on the left is a month by month, quarter by quarter, trailing 12-month calculation of India's exports, India's imports, and the balance would be the trade surplus. So the blue bar here is your trade surplus. The orange bar is your import numbers, and your blue bar is your blue line is your export numbers. What is very clear here is India's trade surplus to the United States, let's say early 2012, was roughly just about $10 billion. In 5-6 years, $10 billion moved up closer to around $20 billion over here. And then 20 billion moved up almost close to 40 during the COVID period. Where we are now, we're almost at $40 billion. So you've seen a very sharp increase in India's trade surplus with the United States, mainly on account of the fact that while imports have also gone up, you've seen a very sharp increase in India's exports to the United States. So like this, across the board, most Asian emerging economies have had a sharp increase in their trade surplus with the United States. The United States is trying to impose tariffs and try to balance this for themselves because they want to reduce their trade deficit. So they're trying to put tariffs on emerging economies, trying to make imports much more costly for the United States, and as a result, trying to also boost domestic demand and encourage domestic companies. What are the tariffs? So this chart was prepared well before the 245% tariff that the US has imposed on China. On the tariff scale, the tariff on India is around 26%. We have to understand that of this 26%, there is a base level 10% tariff. And on top of that base level 10% tariff, you have around a 16%, which takes it to 26. This is the tariff that has been paused for 90 days. Post 90 days, whatever negotiations are ongoing by then, based on those BTAs, bilateral trade agreements, we will understand whether this 26% gets imposed or if it's a completely different number. What are India's exports to the US? As a percentage of India's own exports, India exports around 16% of its exports to the United States. And you can see all these countries export much more as a percentage of their exports. What are the key exports of India? These are the top few exports, but three exports that really stand out. One, they call sound recorders, TVs. A large chunk of this are your smartphones, your mobile phone exports, your iPhones and the Samsungs, etc. The second would be your gems and jewelry, and third would be pharmaceuticals. These are the top three exports of India to the United States. Now, looking at India's exports as a percentage, India's exports to the US as a percentage of its total exports would not be the right way of looking at it from an impact point of view. How else should you look at it? India's exports to the US as a percentage of India's GDP. What is that? It's only 2%. Only 2% of India's GDP is India's exports to the United States. You look at other countries, for example, you look at Vietnam. Vietnam's exports to the US as a percentage of its GDP is fairly high, it's around 25%. China comes closer to India, it's slightly higher, around 3% odd. So on the scale of things, the risk seems a little lesser on the first level. Now, if we were to convert this into numbers and say, what is the export risk for India and what is the growth risk for India? A simple exercise would be to multiply these numbers with 26, multiply the export shares with 26, and respectively for all the other countries, multiply the GDP, percentage of GDP share with 26, and similarly for the other countries. So export and growth risk-wise, if you look at India, we have our export risk is around 4.3, but total export exposure to the United States, if I were to convert that into a GDP number, What is the growth risk for India? It is 0.5% of GDP, which is roughly around 50 basis points. This is the first level impact. One has to very clearly remember that the second order impacts are not priced in this number. This is just assuming that if you shave this 26% of the exports off to a certain extent, what is the impact that will happen? What are second order impacts? Second order impacts are the uncertainties that these tariffs create. As a result of that, is investment coming down? Is global growth coming down? Global trade coming down? What implication does this tariff increase have on inflation in the United States? How much of that is translating into global inflation? Is there any trickle down of this global inflation into domestic inflation? All of these are second and third order impacts. Those are not getting priced in the numbers here because we don't really know how they're going to play out. Now, before we come to this slide, one important point to understand here is that this is a broad framework we have to work with from an impact point of view. Where does India stand on the whole on US's priority list? Now, there are 2 points that we have to understand here. Cutting the tariffs is one aspect, but the more important aspect that the United States is interested in is how can we reduce the trade deficit we have with emerging economies. This is what the US is thinking. So US has a trade deficit with all the other countries, all these countries that you see here, which in other words, these countries have a trade surplus with the United States. So US is imposing tariffs on all these countries because they want to reduce the amount of imports US has from these countries. How does it do it? It imposes tariffs. It becomes very important very costly to import from these countries. As a result, imports start reducing. And when US imports start coming down, you have a lesser trade deficit with the rest of the world. Now, the problem with this is when you impose tariffs, you also have retaliatory tariffs. You cannot escape from that. So when you impose tariffs on these countries from an imports point of view, your imports come down. But because of the retaliatory tariffs of the other countries, your exports also will take a hit. So the second method is to try and have a negotiation with these countries and say, hey, you export so much to us, rather we import so much from you. Why don't you import more from the United States? This is a relationship that you can forge using BTAs, bilateral trade agreements. And based on these agreements, what the US is also trying to do is US is trying to see if India can import more and more from the US. So if you look at this chart here, this chart plots all the countries based on their trade surpluses. You can see the trade surplus of China is the highest, $260 billion. India's trade surplus is around $41 billion. But if you break this down and see where does this trade surplus come from? Let's take an example of India and Vietnam. Vietnam has a trade surplus of around $101 billion. If you break this down, $114 billion is what Vietnam exports to the United States, but it imports only $14 billion. India exports $84 billion, but it imports a much higher number, which is around $43 billion, much higher than Vietnam. So as a result, you look at India's trade deficit is lower because India imports more from the US. Vietnam's trade surplus is much higher than India because it actually imports very little from the United States. So let's convert this entire table into this table on the right. India's imports as a percentage of India's exports. If you rank India sort of tops all the emerging market economies on this basis. So 51%, India imports nearly 51% of what it exports to the United States. Now let's look at Vietnam here. Vietnam imports only 12% of what it exports. So from a US's point of view, if US's priority list, India will stand number one or rather close to number one on the priority list because it can notice that India is importing way more than all the other countries as a percentage of its own exports. So India has a fighting chance there to get a better negotiation, better BTA agreement at the end of all of this. These are the numbers that is very important to understand. Now, if you look at this last couple of points here, so when these trade negotiations happen, just give a small example here. US exports fuel, crude, and natural gas to the world. India also imports crude and natural gas to the world. So India's import of crude and natural gas, it can shift it from probably Russia or some other country and shift it to the United States. So India imports only around 3% of crude and 19% of natural gas from the United States. So from a BTA point of view, just as an example, there is a great opportunity to rebalance these exports and imports because at the end of the day, while the tariffs that have been imposed and paused as of now are elevated, and that seems to be the direction that the United States wants to go, the United States will always want to get into a BTA and reduce its absolute trade deficit with India rather than imposing tariffs. So if there is an option of a better A, US will always take that rather than keep on elevated tariffs. So from an opportunity point of view, India does have an opportunity, and India does rank much better from a BTA, a favorable BTA standpoint. We come to our usual set of 4 charts on domestic macro. This talks about the Naukri numbers. Broadly, they've held well in FY24. Your domestic tractor sales numbers have been fairly strong in FY25, much higher than FY24 numbers. India's electronic exports, they remain very strong. But remember that a good part of these have the airlifting news flows that you've heard. A good part of this electronic export number is also consumption that has happened in advance to stockpile purely because of these tariff concerns. E-way bills, they continue to reflect strength in FY25. So these are the 4 key macro indicators that we wanted to highlight for the month. Now, markets in March. What really happened in March? One key highlight that we were talking about for the month of March was you saw the dollar index come off a fair bit. By the end of March, the dollar index was around 104. As we speak, the dollar index is just under 100. But the key point that we are trying to highlight here is that the weakness in the dollar in the month of March and for a good part of April as well has not been on an additional expectation of rate cuts from the Fed, but has been because of the fact that the euro has strengthened a fair bit. Now, why has the euro strengthened? Because we've seen a very sharp shift, a political shift in Germany, and the political shift under Germany, under the German Conservative Party CDU, led by Friedrich Merz, the political leanings are towards more fiscal spending, which means there appears to be a positive boost for growth that is expected from a market standpoint. And this has been the main reason why European markets have significantly outperformed US markets from the start of 2025, especially from February onwards. So if you look at the DXY index and you break it down, nearly 57-58% of the DXY index is just the euro, which means if the euro strengthens significantly, you will statistically see a drop in the DXY. If you plot the DXY against how the European outperformance, equity outperformance has been, it moves almost hand in hand from the end of 2024. You can see your MSCI Europe outperformance against the US has been increasing substantially. And along with that, you've also seen the euro strength, which means there's been a fair bit of money that has moved from US into euro, weakening the dollar, strengthening the euro, and strengthening flows and strengthening European equity markets. One other bit that we've seen is you look at the S&P 500 and the S&P equal weighted 500. European politics apart, you've seen a heavy influence of IT over here. You've seen a heavy influence of IT in the S&P 500, roughly around 67 IT stocks that account for nearly 32%, and the top 4 IT stocks account for 21% of the index. So you've seen in the last couple of months weakness in S&P 500, apart from a broad-based weakness that you've seen over the last couple of weeks. IT has not performed really well because of recession concerns and other concerns around IT. So you've seen a fair bit of an outperformance of the S&P 500 coming off when compared to the S&P 500 equal weighted index. We then go on to a few charts. We talk about the cycles of India, mid, large, and small cap. You can see the 7th cycle that started around COVID. India is well into its 7th cycle. You're seeing a healthy correction in the equity markets. On the flows front, you've seen a fair bit of flows in debt come in for the month of March at around $3.7 billion. Equity came off from a very negative month in February. It closed marginally positive in March. Your domestic flows continue to remain fairly strong. Your FII flows have still remained weak. On the valuation front, you've seen a marginal sort of a bump up around large, mid, and small caps by end of March. All of these numbers are end of March. Last segment that we come to, what must you know before investing? So we spoke about the SIP example the last time around. This time we look at lump sum investing. So 2-3 takeaways from this. One, we say, see, 6 years is what data tells us. If you are a lump sum investor, you must be invested for a minimum period of 6 years. That is when you have a 0% probability of a capital loss. You then try to get 71% probability of 12% CAGR. For that, you need to really hold on to your lump sum investment on average for around 12 years or so. If you want a higher probability, you need to hold on to your lump sum for a higher period of time. So if you want a 100% probability of 12% plus CAGR, your time frame of investing has to be, for lump sum, has to be around 21 years. Then we go down to the next slide. What are the luckiest and the unluckiest lump sum over a period of time? This chart is as of end of January 2025. So you can see as of January 2025, your 6-year CAGR, your 6-year lump sum return stood at around 12% plus CAGR. But your 10-year, your 15-year, your 14-year, all of them have been marginally below 12% CAGR. Your luckiest lump sum investor return has been 36% plus for a 6-year period, and your unluckiest has been just above 1 or 2%. The point that comes out very clearly in this chart is if you want to reduce the gap between the luckiest and the unluckiest return, or being the luckiest and the unluckiest investor, the key here is to increase your time frame. So 20 years plus, the gap between the lucky and the unlucky investor return narrows almost close to a zero when it comes to the 25 years. So the point that we keep reiterating here is if you are a lump sum investor, 7 years again must be a minimum time frame you must be looking at from a large cap point of view. And the longer you hold on, you are increasing the probability of getting the 12% plus CAGR, and you're reducing the possibility of you being an unlucky investor and your returns coming closer to around 12% CAGR. And finally, the last slide where we talk about a quote. This is from Warren Buffett. So he says, do not save what is left after spending, but spend what is left after saving. With that, we come to the end of the E.M.I. for the month of April. See you again.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.